Welcome to the Consumer Financial Protection Bureau's field hearing on consumer credit reporting. The Consumer Financial Protection Bureau is an independent federal agency whose mission is to make markets for consumer financial products and services work for consumers, whether they are applying for a mortgage, choosing among credit cards, or using any number of other consumer financial products. My name is Zixta Martinez. I'm the Acting Associate Director for External Affairs. Today's field hearing is being live streamed at consumerfinance.gov, and you can follow us on Twitter at CFPB. The hashtag for the event is credit reporting. We'll begin today's field hearing with remarks from some well-known Michigan luminaries. Then you'll hear from CFPB's Director Richard Cordray, followed by a panel discussion on consumer credit reporting, after which you, our audience, will have an opportunity to tell us your story. So why don't we get started with our first speaker. Congressman Hanson Clark represents Michigan's 13th Congressional District, which includes our wonderful venue here today, the Detroit Institute of Arts. We thank him for hosting us. Congressman Clark.
Everyone, I'm Hanson Clark, U.S. Representative, and I am a product of the Detroit Institute of Arts. My mother got me a scholarship here when I was a kid to take Saturday morning classes in art, and I was able to graduate from college first in my family with a Bachelor of Fine Arts in Painting because of this great institution. So I wanted to put in a personal plug for the DIA. I wanted to thank Director Cordray, Deputy Director Date, and all of the members here of the Consumer Financial Protection Bureau. But most importantly, I wanted to thank all of you as our consumer advocates, because you clearly understand the debt that's really burdening our families here in Metro Detroit. And it ain't the federal debt. It's student loan debt, over $1 trillion nationally, and it's robbing our people of financial security or even a chance to make a living or go into business, even if they have a great graduate education. We also are aware, living in Metro Detroit, of the impact of home mortgage debt, what it's done to families, what it's done to our communities, forcing people out of their homes, decimating our property tax base, making it so difficult for local communities to even have the money for police and fire or to keep our schools fully staffed. And just in closing, what makes this debt so onerous here in Michigan is that in this state, if you own an automobile, you're required to have auto insurance. And then the insurers use credit history, the fact that you may have fallen behind in your payments on your student loans or on your mortgages or on your credit card statement. Use that to charge you more money even though you have a perfect driving record. That's outrageous. That's a double whammy. As a member of Congress, I've introduced legislation to help forgive and reduce student loans, help stop foreclosures and write down the home mortgage principles on mortgages, and as Congressman Conyers will share with you, to give this Bureau some power in regulating and hopefully outright banning the use of credit history in auto insurance. Thank you so much for this very important hearing. This is one powerful way that we can create jobs, is by cutting the personal debt that our families have to pay, freeing up their money, increasing their purchasing power. That'll make our economy stronger, not only in Metro Detroit, but throughout our country. Thank you so much.
Thank you, Congressman Clark. Our next speaker is Congressman John Dingell, who represents Michigan's 15th District. He has been a steadfast advocate for consumer rights and is the longest-serving member of the United States House of Representatives in history. Congressman Dingell.
Stairs are a little harder, but it's always worth getting up here and talk to you. Good morning. Thank you, Zixta, for that very kind introduction. And to you, Director Cordray, and your very fine staff and the members of the commission, thank you for being here. Welcome to Michigan. And I want to welcome all of our panelists and those in the audience this morning. This hearing is going to be valuable to us all, including the commission, but to our people here also. It's interesting to note that prior to the Dodd-Frank Act, no federal agency was tasked with overseeing the credit rating companies. These companies play a major role in our economy and have played major roles in the financial collapse that led to the recession from which we are only now recovering. As you all know, your credit rating can make or break your ability to get a loan, to buy a car, to move into a new home, or to move forward financially. I believe that how your credit rating is set must be a transparent process, and it is one which should not be based on smoke and mirrors and secretive ways of doing business. I want to commend Director Cordray and the CFPB for working to move forward on a new set of regulations for credit rating bureaus. It is very much needed. I understand the new regulations will be out at the end of July, and I hope that the CFPB will move with all speed and due deliberation to make that event a reality. What the CFPB is doing is helping consumers by protecting their interests and making sure the bad actors on Wall Street and elsewhere don't take advantage of the ordinary citizens on Main Street. I wholeheartedly support the CFPB and in fact played a small role in its creation when the Congress started the whole process of financial reform back in 2009 and 2010. My colleagues who are here with you this morning, Gary Peters, who had much to do with the enactment of this legislation, my friend John Conyers and Hanson Clark and I are going to continue to work together to make sure that the CFPB has the funding and the other resources that it needs to protect all of our citizens and to see to it that the malevolent forces seeking to do away with their success are brought under sufficient control that they can participate in a useful way in the government. We need strong, sensible financial regulations. And Director Cordray, we know you're doing that, and we're pleased, and we wish you great success in that undertaking. We commend you for your work, and we hope that you'll call on us in the delegation to be of help in whatever way we can. So again, welcome to Detroit, to the DIA, which, as you will see, is a great treasure. And by the way, I just mentioned a quick aside, there's going to be a vote on the ballot shortly to increase funding for this wonderful institution. And it gives me a chance to just mention that those of you who are voters might want to come out and help DIA to see to it that they get the support they need to preserve this treasure for us, so that not only can the CFPB, when they come to town, conduct their business here, but we can continue to derive the wonderful benefits of this institution. Thank you for the privilege of being with you.
Thank you, Congressman Dingell. Our next speaker is Congressman John Conyers, who represents Michigan's 14th Congressional District. He is the ranking member of the House Judiciary Committee and was also a member of the conference committee that wrote the Dodd-Frank Wall Street Reform and Consumer Protection Act, which created the CFPB. He is the second most senior member in the U.S. House of Representatives. Congressman Conyers.
Top of the morning, friends. I'm delighted to be here. I'm an old visitor to the Detroit Institute of Arts because of my interest in jazz and the musicians and the music that has been here so often. And we appreciate this kind of a forum, and we're delighted to be here. I urge, as Chairman Dingell did, that we think about the millage involved in that can come to the DIA, but also in the voting process itself. I'm one that is trying to figure out new ways to motivate more people, particularly in the primary. The general, okay, but the primary vote, which is actually the gatekeeper to whether you even get to the general, is frequently ignored. And so I join in, as you've heard from Ms. Martinez, my support of the Consumer Financial Protection Bureau is very great. Congressman Clark mentioned this overhanging student loan debt, and he has a bill that I know I'm on. There are probably others that are dealing with this important relationship of credit history to car insurance. And the Clark bill is worth our examination. Now, I have no idea what these 9 panelists are going to talk about, because after Congressman Peters gets through all of us, I mean, we've said it all. We can go directly to the questions and commend the panelists for everything that they're doing. My last observation that I think is related to this is the whole question of deregulation. There's a move on among conservatives in the federal legislature to deregulate everything. And I think it's connected with this other related theme that they advance and that I oppose, is that we need smaller government. Let's make things smaller and less. And that kind of attitude would have never got a Financial Protection Bureau off the ground. And I think this is where the discussion comes from us, that we have to examine where this is. I'd like to get some conservative legislators here to show another point of view, if there is one, on this important subject. Thank you very much for letting me make a brief presentation.
Thank you, Congressman Conyers. And just a point of clarification, we did invite the entire Michigan delegation to join us today. Our next speaker is Congressman Gary Peters. He represents Michigan's 9th Congressional District and serves on the House Financial Services Committee and the House Small Business Committee. He was also a member of the Conference Committee on the Dodd-Frank Wall Street Reform and Consumer Protection Act, which, as I noted, created the Bureau. Congressman Peters.
Thank you, Director Martinez, and welcome back to Michigan as well. You were with me at a hearing that we had in my district to talk about the important work of the Bureau. It's great to have you back, and Director Cordray, it's great to have you, and it's great to have you head of the department finally, so we can move forward. This is an interesting time for us to have this hearing, in the fact that this is really about the 2-year anniversary of Dodd-Frank, which was the most sweeping Wall Street reform since the Great Depression. As was mentioned, I was on that conference committee, and I remember 2 years ago spending hours and hours locked up in rooms as we negotiated this final version of this. And certainly this Protection Bureau is a key part of the Dodd-Frank bill that we need to make sure is strong and can continue to do the work for consumers. Before this Bureau was formed, there wasn't one single agency that really could oversee all of this, and in fact there were huge gaps in the types of protection that was available for consumers. And I always thought it was quite interesting that we have significant consumer protection when it comes to physical products and the physical things that we deal with, and yet prior to Dodd-Frank, when it came to financial products, there was very, very little protection, and in fact it was only disclosure, and people said, well, you should have read the fine print, and you should have read that big, thick document you get when you get with a credit card. And as we all know, that big, thick document doesn't contain consumer protections in that big, thick document. It's all the ways in which you can be tripped up. And I like to give the example of the fact when you buy a product, if you buy a toaster, for example, when you buy that toaster, you usually feel pretty comfortable that that toaster is going to work and it's not going to electrocute you. because we have consumer protections in there. In the financial products industry, there isn't any. It says you should have looked at the fine print. So if you make that comparison to the toaster, it would have been like you use the toaster and all of a sudden it electrocutes you. And someone says, well, you should have looked at the schematic and seen that after 3 uses it was going to electrocute you. Quit complaining. Well, we can't have that kind of process. We have to have protections up front to make sure that that doesn't happen. And a part of that certainly is more than disclosure. It's having that impact up early, particularly when it comes to differences depending on communities. The Consumer Financial Protection Bureau will be dealing with, and I hope to hear during this panel, in addition to credit scoring, how different communities get impacted dramatically in the financial system, particularly our urban communities and minority communities that are paying higher fees. And as from example of some of the news that we've been getting with some practices that are related to mortgages, we find out that urban areas, particularly African American buyers as well as Latino buyers, pay higher interest rates on average, are not in prime mortgages, tend to be in subprime mortgages, and pay much higher fees, which then leads to more defaults and then leads to a destruction of their credit rating as well. In fact, a recent Department of Justice investigation, which really focused on Wells Fargo, and you may have read about the recent settlement with Wells Fargo, showed that between 2004 and 2009, their independent brokers, they found that highly qualified African American borrowers were 4 times as likely to receive a subprime loan as similarly qualified white applicants. Even though they qualified for a prime loan, they were put into subprime. Hispanic borrowers were 3 times as likely to get a subprime loan, and in addition to being in these higher loans with much higher interest rates, that they fully qualified for lower rates, when Black and Hispanic customers got prime loans, they paid higher fees than white borrowers. The average African American taking out a prime loan was charged $2,000 more in broker fees than a similarly qualified white customer. Latino borrowers paid an average of $1,251. This is why we need the CFPB. We have to end this process. We have to make sure that everybody, no matter who you are, no matter where you live, you are treated the same way as anybody else in this country. And if you are not treated that same way, and you're put in a situation then when your credit report then gets damaged as a result of this, it's difficult for you to get auto insurance now with these outrageous laws that we have. It's difficult for you now even to get a job. We have employers that are using credit reporting to determine whether or not to hire somebody, and we don't know the accuracy of that report, and it may be because of the discrimination practices within the lending themselves. So this Bureau's job is extremely important. It impacts people's lives each and every day. And I'm going to say my colleagues here in the front row, we are fighting right now efforts to try to limit this Bureau's ability to move forward. They want to attempt to take the resources away from this Bureau so it doesn't do its job to protect American citizens. So I appreciate all of you coming out today. I appreciate your testimony. I look forward to hearing from the panelists, but we have to stand firm. The American people deserve to have a strong protection bureau that protects our finances. Thank you for being here.
Next is the Consumer Financial Protection Bureau's Richard Cordray. Richard Cordray is the CFPB's first director. Director Cordray?
I hadn't quite seen this from this angle yet, so I'm just sort of taking it in. Thank you all for coming today. We're glad to be here in Detroit to hold this field hearing, and we're especially glad to be here at the Detroit Institute of Art, which is a magnificent edifice and foundation, just the kind that we hope to build at the Bureau for the years ahead. I myself am Midwestern, born and bred. I'm from neighboring Ohio, and I received my undergraduate degree from Michigan State University, where I was a classmate of Magic Johnson, and where I still have many lasting friends. So I'm well aware that this state has suffered greatly in the last 10 years with the 1-2 punch of lost manufacturing jobs and then the foreclosure crisis. People here, as in some other parts of the country, understand what it means to fight hard to find traction in a tough economy. After the financial crisis and the extreme credit crunch of 2007, 2008, tens of millions of Americans are now being pursued by debt collectors. Many people's credit ratings have taken a hit, and now they're having a tough time regaining their financial footing. They're blocked from obtaining access to the credit that is so often essential to meaningful opportunity, to get an education, start a business, or buy a home. We understand these realities at the Consumer Financial Protection Bureau because we hear about them from consumers every day. We also believe it's important to get out of Washington and listen directly to consumers by meeting them face to face. So we're glad to be here with you today and have you help us better understand how credit reporting companies, also called consumer reporting companies, affect people's daily lives for better and for worse. These businesses track your credit history and payment records, and they analyze the information to determine what risks are posed by extending credit to you in the form of any kind of loan. Over the years, they have made it possible for a broad system of individual credit to grow and develop in our country, which has encouraged and promoted people's pursuit of the American dream of financial success. But whether you realize it or not, their scorekeeping exerts a tremendous and growing influence over the ways and means of your financial life. And so it's important for all of us to understand more about their work and about the ways it can affect us. Today, the Consumer Bureau is issuing a new regulation to expand our supervision program to oversee these credit reporting companies. The authority to supervise firms is the authority to conduct on-site examinations of whether and how they're complying with the law. It affords an opportunity to gain a more thorough understanding of their business models and business practices, to work with them to correct any problems we find, and to find ways to resolve matters that may be causing harm to consumers. Before we open this hearing, I want to take a few minutes to discuss the credit reporting market and our role in overseeing it. This is a field hearing. We're here to listen, to learn, and to gather on-the-ground information that will help inform our approach. We're thinking hard about the issues in the credit reporting market, and we do not yet have all the answers worked out by any means. We need your help and your insight. As Henry Ford once said, if there's any one secret of success, it lies in the ability to get the other person's point of view and see things from that person's angle as well as from your own. We believe in the wisdom of that statement, so please tell us what you think today. Let me start by talking about the credit reporting market. Credit reporting plays a critical role in consumers' financial lives, as has been mentioned, a role that most people do not recognize because it usually is not very visible to them. Credit reports on a consumer's financial behavior can determine a person's eligibility for credit cards, for car loans, for home mortgage loans, and they often affect how much a consumer is going to pay for that kind of loan. If you have a credit record that appears to show a greater risk that you'll fail to repay a loan, then you may be denied credit altogether, or you likely would be charged higher interest rates on any loan that is offered to you. Our credit reporting system involves several key participants. First are the creditors and others that supply the information about your financial behavior, which can include your credit card issuers, your mortgage company, or companies that are collecting debts they claim you owe, among others. Second are those that collect and sell the information, which are the credit reporting companies. Third are those that use the information, which largely consist of financial institutions, but can also include insurance companies, auto dealers, retail stores, and even prospective employers. Fourth are consumers themselves, who are the object of all this scrutiny and who are immediately affected by it. That's you and me. All of these participants play important roles in ensuring that the credit reporting system operates effectively to help consumer credit markets work better for us all. The credit reporting market is huge. Almost every adult in America has a credit file. Estimates are that each of the three biggest credit reporting companies maintains files on about 200 million Americans, gleaned from over 10,000 providers of information. The amount of information collected and exchanged is astounding. Each year, approximately 3 billion credit reports are issued, and more than 36 billion updates are made to consumer credit files. A credit report contains information about the consumer's transactions, including loans that a consumer has paid on time, has paid late, has not paid, or has paid off, along with current amounts and sources of debt. The credit reporting companies also collect and report on information about consumer finances available from public records, including civil judgments, liens, and bankruptcies gathered from thousands of federal, state, and local courts and public offices. The information contained in consumers' credit reports is used to derive their credit scores, such as various versions of the 3-digit FICO score. Credit scores translate this great mass of information into a single number that indicates, in shorthand, a consumer's expected likelihood of repaying a loan. Generally, the lower the score, the lower a consumer's perceived likelihood of repaying the loan compared to other consumers. But credit reports are also used in a wide range of other types of decision-making, including determinations about eligibility for rental housing, what deposits are required for utility or telephone service, and premiums, as mentioned, for auto and homeowners insurance. Credit reports are even sometimes used, and increasingly used, to determine eligibility for a job. Banks, landlords, cell phone providers, and all kinds of other companies rely on the accuracy of this information to make good decisions and manage their risk of suffering losses. Credit reporting is an important element in promoting access to credit that a consumer can afford to repay. Without credit reporting, consumers would not be able to get credit except from those who already have had direct experience with them. For example, from local merchants who know whether or not they regularly pay their bills. This was the case 50 or 100 years ago with store credit, or when the consumer really only had the option of going to the local bank. But now, consumers can instantly access credit because lenders everywhere can look to credit scores to provide a uniform benchmark for assessing risk. Conversely, credit reporting may also help reinforce consumer incentives to avoid falling behind on payments or not paying back loans at all. After all, many consumers are aware that they should make efforts to build solid credit. So this critical market is at the heart of our lending systems. It has enabled many of us to get credit and to afford a home or a college education. But it is also clearly a market that can cause considerable problems for consumers. For example, sometimes credit reports contain errors that inaccurately reflect people's financial histories and can unfairly block them from getting approved for credit or make it cost more than it should. Consumers also can encounter great difficulties at times in getting errors corrected. When the Consumer Bureau first opened its doors almost a year ago, we asked people to share their consumer experiences with us. They've been doing that ever since. And we've heard reports from many consumers that their credit reports are not accurate and it's difficult to get them corrected. Because of the critical role that credit reports play in consumers' lives, it is our job to make sure we understand the full extent of these problems and address them effectively. Given its enormity, given its influence, and given its wide impact on our overall economy, you can see there's much at stake in ensuring that the credit reporting market is working properly for consumers. Today, the Consumer Bureau is announcing that we will be supervising the credit reporting companies that are the larger participants in this marketplace. These companies have never before been subject to any federal supervision program. Starting this September, we will be monitoring and examining them just as we monitor and examine the big banks. Our new supervision authority means that we will now have a clear window into the entire credit reporting system. Up to this point, no single federal government agency could access all the information necessary to generate a complete picture of what was happening inside these companies. Now, the Consumer Bureau has the clear authority to oversee this industry, including the very largest credit reporting companies. Our oversight will also extend to specialty credit reporting companies, such as those that focus on payday loans or checking accounts, as well as resellers of credit reports and those that analyze credit report information. This new supervisory authority will complement our existing authority over the creditors that supply much of the information to the credit reporting companies. Our country's credit system is a resource in which we all have much at stake, both directly and indirectly, and we need this system to operate effectively in order for the credit markets to work properly and fairly. Because no federal agency has previously had the kind of broad access to information about the operations of the credit reporting companies that the Bureau will now have, there's much we do not know yet about the true risks that consumers face in this market. As we go forward, we will be gathering data to determine how the various parts of the Consumer Bureau can best act to protect consumers. We start with 3 areas of focus. First, our oversight of the credit reporting companies will help us make sure that the information provided to them in the first place is itself reliable. Lenders and others who furnish information to the credit reporting companies are legally required to have policies in place about the accuracy and integrity of the information they report, which includes identifying consumers accurately, correctly recounting their actual payment history, and keeping their information and record keeping in order. Otherwise, their sloppy work becomes the true source of harm to the consumer's overall creditworthiness. We want to deepen our understanding of the record keeping and reporting practices by lenders, and we want to see what the credit reporting companies can be doing to test and screen for the quality of information they receive. Second, given the number of complaints we've already heard from consumers and the findings reached in some, but not all, reports on the subject, we want and need to know more about the accuracy of how the credit reporting companies assemble and maintain the information contained in consumer credit reports. Accuracy is critical for consumers and for markets. We recognize that achieving such accuracy takes a great deal of discipline and effort, particularly for a company that is handling and processing a huge volume of information. But because of the increasingly significant role that these reports are taking on in our financial lives, the collateral consequences of mistakes can greatly harm consumers. The wrong information may cause them to be denied a loan, to be charged a much higher interest rate, or to be passed over for a job, causing them serious economic hardship. And inaccurate credit reports also deprive lenders of essential information they need to assess credit risk properly. Third, we're keenly interested in understanding more about the problems and frustrations that consumers tell us they encounter in trying to resolve disputes about the information contained in their credit reports. Some errors may be unavoidable even in the best of systems. But when consumers find what they perceive to be erroneous information in their credit reports, they should not be burdened by unreasonably laborious processes to get errors removed from their files. There are certainly valid reasons why a credit reporting company must conduct a reasonable investigation when a consumer disputes information and follow the procedures outlined in the law. But the harm done by errors is borne above all by consumers, and they deserve straightforward, effective, and timely mechanisms for addressing disputed items. These initial areas of concern, accuracy of the information received by the credit reporting companies, their accuracy in assembling and maintaining the information, and the processes that govern error resolution are just a start. They are the obvious and essential basics. But as we learn more about this market from consumers, from the supervised firms, and from others, we will adapt and adjust. The Fair Credit Reporting Act sets out an ambitious goal. Credit reporting companies, quote, shall follow reasonable procedures to assure maximum possible accuracy of the information contained in credit reports. In this context, we're here to correct what is not going well, and we're here to see that this market is made to work better for those who are affected the most. And we will exercise our supervisory authority to make sure that the consumer financial laws are being followed. So the credit reporting industry is continuing to become more central to people's lives, just at a time when they're experiencing widespread problems with credit availability. Many Americans have been greatly affected by the financial crisis, the housing crash, and the deep recession that followed. Today, because of accumulated debts, foreclosures, and bankruptcy filings, many people have more negative information on their credit reports than they did before the crisis. As I said earlier, this country's credit reporting system is a resource in which we all have a stake. The system must merit our trust and confidence for the credit markets to be perceived as fair. We all share in this responsibility, but the credit reporting market is not one where consumers can shop around among different providers. For people have no choice about whether to have any of the credit reporting companies keep track of their credit history. That's going to happen whether you like it or not. That's why the Consumer Bureau's new authority is so important and why it must be exercised carefully and effectively. What consumers can do, however, is be as smart as possible about how they manage their own credit. They need to know how to build up their credit worthiness so they can take control over their credit history in a positive way. They also need to be aware that federal law gives them the right, Congress has passed this law, to a free credit report from each of the nationwide credit reporting companies, which can be obtained at annualcreditreport.com once each year. It's critical for each of us to exercise that right. Keep in mind that nobody else has as much incentive to protect you as you have to protect yourself. Checking your credit report can reveal odd entries that you do not recognize, which may be signs of identity theft. It also can uncover errors that will hurt your creditworthiness unless you dispute them and get them fixed. I urge every consumer to perform this self-check at least once every year. Starting today, we're including advice about how to do that in the Ask CFPB function on the Consumer Bureau's website at consumerfinance.gov. Our website also provides tips for consumers on how to manage their credit generally, how to get and keep a good credit score, and how to navigate the consumer credit markets. So as we wade into these issues, we look forward to hearing more from you both today and in the future. Share your thoughts and experiences. We're intent upon hearing from consumers about their personal experiences to inform our work. To quote Henry Ford once again, coming together is a beginning, keeping together is progress, working together is a success. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite our panelists to join the stage. The CFPB's Deputy Director, Raj Date, will lead our panel of experts through brief statements and Q&A. While our panelists take their seats, I'd like to take a moment to thank those joining via live stream. The CFPB's website address is consumerfinance.gov. You can follow us on Twitter at CFPB. The hashtag is credit reporting. Deputy Director Date, you have the floor.
Thank you, Zixta. As Zixta just mentioned, we'd like to step into the next phase of our field hearing this morning. And there may be a way to turn on this microphone that I'm not aware of. Much closer. In this phase of the field hearing, what we'd like to do is hear from experts who know a great deal about the consumer reporting system in the United States. Experts on two panels, which are drawn from the industry and industry representatives, as well as experts who spend a fair amount of their time thinking about how it is that the consumer reporting system in the U.S. impacts consumers, creates issues or problems or opportunities for consumers over time. Here's how we'd like to conduct this portion of our hearing. We'll ask both sets of panelists to provide opening statements, which, owing to the constraints of time, will have to be slightly more brief, I think, than any of us otherwise would want. And we'll take an opportunity for my colleagues here at this table from the CFPB to be able to follow up with some questions. But before we do any of that, why don't I introduce the folks who are up here with me. You have already met the director of the CFPB, Richard Cordray. To my left is Peggy Toohey. Peggy serves as the Assistant Director for Non-Bank Supervision at the CFPB. To my right is Tom Osherwitz. Tom serves as the Program Manager for Credit Information Markets at the CFPB. And now, all the way on the my left-hand side is Stuart Pratt. Stuart serves as the President of the Consumer Data Industry Association. Next is Ms. Ann Wallace. Ms. Wallace is the President of the Identity Theft Assistance Corporation and is also the Senior Director of the Consumer Financial Services organization at Financial Services Roundtable. To her right, I suppose that is Mr. Terry Clemens, who's the Executive Director of the National Credit Reporting Association. And now, stepping all the way to Tom's right is Professor Mary Spector. Professor Spector joins us from SMU's Dedham School of Law. And then finally, Mr. Bill Sermons. He is the Director of Research at the Center for Responsible Lending. So why don't we begin with our consumer-focused panel, and before we do that, I should also acknowledge that a third panelist had meant to join us this morning, Professor Howard Beals from the George Washington University, owing to an unanticipated travel mishap, the likes of which I have suffered many times. He's unable to be here, so just want to thank him for being willing in any event. So why don't we start with you, Mr. Sermons, for your opening statement.
Thank you. I'd like to thank CFPB Director Cordray. Can I move it closer? All right. Is this better? There we go. So I'd like to thank CFPB Director Cordray, Deputy Director Date, and also Assistant Director for Community of Affairs, Zixta Martinez, for having me and the entire Consumer Affairs staff for this opportunity to talk about what has really become a factor that's really central to the lives of consumers, which is consumer credit reporting. In the wake of the Justice Department settlement with Wells Fargo last week that provided further evidence of the discriminatory lending practices that led to the financial crisis, we at CRL are heartened to hear the announcement by Director Cordray that the CFPB intends for its oversight of credit reporting agencies to result in greater accuracy in credit reporting and greater accountability to those agencies in the dispute resolution process. Of course, the identification of which reporting agencies to oversee and stating the intent to improve accuracy is just the beginning, and I'd like to highlight 3 things that we'd like for the agency to consider as it moves forward. First, the inaccuracies in credit reports represent a significant risk to consumers, to the institutions that lend to them, and to the economy as a whole. Having a reliable way to assess a consumer's ability and willingness to repay is essential for providing access to the safe and affordable credit that allows Americans to become homeowners and to build wealth. Reports have estimated that between 3 and 37% of credit reports retain errors, and the burden to find, dispute, and resolve those errors rests too much on consumers. For the sake of consumers and for the sake of our entire economy, these errors must be dramatically reduced, and the process to resolve them must be improved. Second, the CFPB should protect consumers from the unfair debt collection and predatory lending practices that are facilitated by credit reporting. Some debt buyers and debt collectors routinely misuse their ability to furnish information to credit reporting agencies as a way of coercing consumers to pay debts that either don't belong to them, have already been paid off, or may have been discharged in bankruptcy, and so they have protection from those. Additionally, some of the most egregious predatory lending practices are targeted primarily or even exclusively to people with blemished credit. In the run-up to the housing crisis, it was common for predatory mortgage lenders to seek out African American and Hispanic homeowners with equity, but with blemishes on their credits in order to bleed the equity from their homes in the form of fees. And last year, we released a report on what is called a yo-yo scam, which is an auto lending abuse that is really targeted and depends on people having no other options other than a dealer for which to go to in order to get a loan. And lastly, we'd like for the CFPB to fully account for the impact of the inaccuracies in consumers' credit reports when it evaluates the impact of greater accuracy. It's not just the denial of credit, it's also where people can live, the jobs they can keep, whether or not they can keep those jobs, and whether or not they can pay for insurance. So I'll quickly summarize that we'd like for the agency to set the expectation of 0 errors and hold agencies accountable for meeting that expectation, to protect consumers from unfair treatment in terms of abusive lending, and also to fully account for the impact of inaccuracies as it considers remedies. Thank you.
Thank you, Mr. Sermons. Professor Spector.
Can you hear me? Okay. Thank you, Director Cordray, and to all the members of the Consumer Financial Protection Bureau for the opportunity to be here today. It is a beautiful space and a treat to come up here from Dallas, so thank you. I teach in a law school clinic. I supervise students who represent low-income clients with all kinds of problems. Many of our clients have been sued by debt buyers to collect consumer credit card debt. Those consumers often find themselves what I call the 1-2 punch. And that 1-2 punch comes when the public records of that litigation show up on credit reports. The first punch comes from the collectors. The collectors, because the litigation may itself involve unfair practices. Much of that litigation is centered in urban areas and communities with high minority populations. Some of the unfair collection practices in the litigation include suits to collect stale debt or suits to collect accounts that have already been paid. One study of debt collection litigation by debt buyers found that more than 75% of the cases included affidavits that we've now come to know as robo-signing. 50% of the cases result in dismissal. Fully 12% of cases served are filed in the courts are never served on the consumers. And 40% of the cases result in default judgments. In the case of a dismissal or a default judgment, often the first time the consumer learns about the litigation is when she sees the credit report, when she's applied for a loan, a mortgage, or a car loan. That's when the consumer suffers the second punch. It doesn't come from the collector, but it comes from the Fair Credit Reporting Act. First, the credit reporting agencies are entitled to rely on the accuracy of the public records. That means that even if the records are wrong, the consumer has no remedy in the first pass at correcting the report and has to wait until a reinvestigation of some sort occurs. And that means time, lost credit opportunities, jobs, or apartments. And in many cases, the only opportunity or what the consumers present to the agencies never actually makes it to the furnisher of the information. The automated dispute process is another process. As Mr. Sermon said, it's one that is very difficult for consumers to manage. It often means that people aren't reading the records carefully that the consumers are providing to the agencies, and little, if any, relief is available for consumers after using the dispute process. These problems are real, but I'm optimistic they can be corrected with the supervisory authority of the CFPB. Some potential solutions would include limiting or preventing the use of name-only reports, which collect broad information about people with similar names or social security numbers and are far over-inclusive. A second type of remedy might be the limit of types of public records that are reported, such as preventing the reporting of filings at all without a disposition of that litigation. A proposed IRS regulation already prevents the reporting of certain kinds of medical debt. And third would be to expand or enhance the dispute process, to make it more transparent, to permit the consumers with more flexibility in challenging incomplete as well as inaccurate records. These are only a few suggestions. I know that the Bureau will hear many more. What's clear is that reform is necessary, and with today's announcement, it appears to be on the way. Thank you.
Thank you, Professor Spector. Why don't we, before we move to the next panel, spend a few minutes just following up on some of the issues raised by the last two speakers. And uncharacteristically, I will allow someone else to ask first. Tom?
Thank you, Raj. To start off, we'd like to ask the panelists to help us put the role of credit reporting into some context. So, compared to a generation ago, how does credit reporting affect consumers' lives? What's changed? For Bill and Barry.
Well, I can start by saying that when the Fair Credit Reporting Act was first enacted, there was not nearly the kind of technology that we have today. And so the increase in technology changes the whole system, from the collecting of the data to the reporting of the data, to the dispute process, to challenge the reports of the data. So that would be one of the biggest changes that has occurred.
I think I would certainly agree. I also think that the issue of identity theft is a big one. The responsibilities or the opportunities for there to be errors in reports have increased both from that perspective and for the kind of data mining that's going on in order to construct records. I also think the consolidation into, I think a $7 billion industry of the big three credit reporting agencies also reflects a big difference from how things were done when my parents were applying for homes and that sort of thing.
I wonder if I might follow up on a couple of elements that both of you mentioned, actually. You both talked about potential problems for consumers within the credit reporting system, but also the potential, it seemed, that those problems do not uniformly visit all consumers, that consumers in some circumstances are more likely to be afflicted by certain kinds of problems than others. Could you just say a little bit more about that, particularly in light of the fact that we are still recovering from the financial crisis, a credit event across the country that is virtually unprecedented?
Right, and so I think Congressman Peters actually, I think, answered this question really well. And I actually probably, the thing I would not want to get away from here without talking about is the fact that this Wells Fargo settlement really, sort of lays bare the kind of discrimination that was going on in the years in the run-up to the financial crisis. So African American and Hispanic home buyers who should have gotten safe loans, fixed rate loans that they'd still be repaying, did not get those loans. Their white counterparts who had the similar qualifications got those safe loans. And the outgrowth is really appalling. Here in Michigan, a CRL study that we put out last year shows that 45% of African American homeowners who bought homes in that time period have either lost those homes or will lose them. 45%. 21% of all buyers in Michigan fall into that category. And so, what we see there is that, that outright discrimination caused a foreclosure, which will take 7 years to get off a record, which may keep somebody from getting a job, which then may keep them from being able to buy a home, which really will have intergenerational impacts. And so I think that not only will these impacts stay with people for years to come, but maybe even for generations to come if they can't live in safe communities because they can't rent there. And so I think that I can't understate or I can't overstate, what this impact has been and the differential impact on African Americans and Hispanics.
Well, it's not just in the mortgage industry. It's in the payday lending industry, and it's also been in the debt collection industry as well. There are studies that show payday lenders and other alternative financial products are marketed more aggressively to minority communities, African American and Hispanic families, many of whom are single-parent families who look to that kind of credit to meet the weekly bills. That debt is aggressively collected, and that means it's collected in neighborhoods that are collected from minority and other lower income borrowers. That has a tremendous effect when that collection account appears on a credit report. It can appear as a collection account, it can appear as a judgment, and so it can keep appearing for quite a long time after an original default.
That's helpful. I think we have time to follow up on one or two more questions. Peggy?
Good morning, everyone. I want to get back to the general issue of credit report accuracy. As we've talked this morning, the accuracy of credit reports is critical to consumers and to the system. If you could give us, Professor Spector, your perspective on how are we doing in terms of credit report accuracy? What's your general perception of the accuracy of the system?
Well, accuracy, it sort of depends on what you mean by accuracy, okay? Broadly defined, the National Consumer Law Center says that inaccurate reports account for nearly 40% of all consumer reports. That's a lot of inaccuracy. Other reports put the number someplace smaller, as low as I think Bill mentioned 3%. But then again, it depends on how you define inaccuracy. A study from the Federal Reserve shows that more than 11% of all medical collections that appear on credit reports have already been paid. Okay, showing accounts that have already been paid will then have a negative effect if the account is being shown as open or delinquent, and we know how medical debt is handled. It takes time often for the various entities involved to get the payment to each other. And so that has a tremendously negative effect on consumers who are already suffering from health problems as well. The Columbus Dispatch, our director's home state, the newspaper there recently published a 4-part series that was really terrific on credit reporting. It looked at complaints that were filed with the FTC and certain attorneys general, and it found that of the complaints filed, more than 15% of those complaints related to errors in reports related to public record errors. And those are the ones that we presume to be accurate.
Thank you, Professor Spector. And Bill, did you want to add that?
Yeah, I would simply add that, I think that the, if you think about the low number, the 3%, that really still is 6 million consumers. And that's just too high for there to be inaccuracies that high. And I think that, Mary mentioned the medical industry or medical debts. I think the medical industry has taken great strides in recent years to use technology, even simple technologies like checklists, to get rid of errors and take them from errors that are on a percent basis to an error per 10,000 basis. And I really think that the industry itself, the credit reporting industry, needs to take responsibility for the accuracy, not just responsibility for resolving disputes, but to be able to really say, I can stand behind this report that it's an accurate report.
I wonder, before we move to the next panel, in a sentence or two for each of you, financial education is an important part of the Bureau's mandate. So if there's one thing that you wish that every consumer in the United States knew about the consumer reporting system, what would that one thing be?
That they could get a free credit report every year and know what's on it, just as Director Cordray indicated.
If they know that, I would have them, if they have a problem, to write down the problem and send a written complaint to the Consumer Reporting Agency to start a dispute process.
Well, thank you very much, both of you. Why don't we turn, in the interest of time, to our second panel. And again, why don't we begin with opening statements, and Mr. Pratt, if you wouldn't mind starting.
Thank you very much, Director Cordray. Thanks for the invitation to be here today, and the same to Deputy Director Date and all of the CFPB staff. We appreciate the fact that you've invited us as industry to participate in this field hearing, and our time is short, so I'll just make 3 key points, and then we can dive into a little Q&A, and I think that's always a richer way to work our way through the details. But the first is, and I think that Director Cordray, you indicated some of this in your own opening remarks, and that is that the credit reporting system we have in this country today, which, by the way, is studied all over the world because it is the most successful system in the globe today, has done something that was absolutely necessary in our society. It has replaced bias and opinion with facts and data. That's very important. We're judged based on the decisions we've made, and by and large, these are good decisions. We're judged based on a history that sets into place maybe even a struggle that one of us has had during the Great Recession, but sets it into the context of a consumer who's worked hard for all of their life and they've made payments throughout their whole life. So it is a credit history. It tells our story across the decades of our life as we interact with the financial services industry in this country. So in our mind, the credit reporting system establishes a baseline of fairness that just simply wasn't there before. It also encourages competition. Competition drives down price. Competition encourages more choices, and we think that's critically important in any healthy financial services marketplace. And because of that choice, consumers can learn what products are best for them and sometimes learn which products are not best for them. Finally, credit reporting systems, our members in the CDIA protect consumers. Our data and our systems, our analytics are on the front line of preventing identity theft. We partner and deliver right at the front end of the application the types of products that are available to consumers, and we make sure that identity theft is stopped before it is started, and that's critically important. Let me just talk a little bit about this new relationship we have with the CFPB. And I'm being told I have less than a minute to go, but I've never been told I don't talk fast. So let me just take a run at it here. Regulation is not new to us. Laws are not new to us. Working with state attorneys general is not new to us. And we see this as simply an extension of the dialogue we have always had, albeit one that will be a little bit different going forward. But I'm very encouraged by something you yourself, Deputy Director Date, said, and so I'm going to quote you here, if you don't mind. And that is, Deputy Director Date said the following: "First, we are committed to basing our judgments on research and data analysis. We won't shoot from the hip. We won't reason from ideology. We won't press a political agenda. Instead, we're going to be fact-based, pragmatic, and deliberative." I don't think I could have said it better myself. That is an excellent framework for that dialogue to continue forward. We certainly, as the credit reporting industry, look forward to having that dialogue. CDIA looks forward to working with our members to ensure that your views are shared within our industry, and likewise, their needs are shared with you. And just in closing, I'll just say that CDI's members have never waited for regulators or laws to tell us what to do when it's right. Going as far back as 1960, we established data practices which ultimately influenced and framed the Fair Credit Reporting Act. And when it was enacted in 1970, the same is true in the 96 amendments to the FCRA, and the identity theft initiatives we put into place, which were acknowledged by the Clinton administration, were in large part what was codified in 2003 in order to assist consumers who were victims of identity theft. So we look forward to continuing to be an industry that is proactive, independent of our regulators, and we look forward to the dialogue that we certainly will have going forward with the CFPB. Thank you.
Thank you very much. Ms. Wallace.
Thank you so much, Director Cordray and Deputy Director Date, and also Representative Clark. It's lovely to see you all here this morning. I'm Ann Wallace, and I am president of ITAC, the Identity Theft Assistance Center. That is an affiliate. We are an affiliate of a nonprofit affiliate of the Financial Services Roundtable, and we have a very special mission. It is to help consumers recover from identity theft. Our mission is to help consumers recover, to educate, raise awareness about identity theft and how consumers can protect themselves, and finally, to partner with law enforcement to catch the criminals who commit this terrible, terrible crime. Well, I don't have to tell you that identity theft is a terrible crime, and it's the #1 complaint received by the Federal Trade Commission last year, and that it can wreak havoc with your credit report. But let me just quickly tell you about this service that we have. We have helped 110,000 consumers recover from identity theft since 2004, including 3,000 from the state of Michigan. The way this service works is that you first go to your financial institution that's a member of ITAC, report the problem. They'll solve the problem within that bank or credit card issuer, and then they'll refer you to ITAC, where one of our agents will get a tri-merge, a credit report from all 3 credit bureaus, and walk the consumer through that credit report to find any mistakes, to find any fraud that's happened. Then we help the consumer correct any problems that exist and notify all the companies where fraud has occurred or is suspected. Now, the obvious benefit to this is that first of all, it's a calm, reasonable voice on the phone, a helping hand at a time consumers really need it, and it just cuts the length of time that it takes for a consumer to recover from identity theft. So it's a terrific service. And what's more, it's the starting point for our partnership with law enforcement, because we use the information, we take that information that we've accumulated from the identity theft incidents and feed it into the Federal Trade Commission's Consumer Sentinel database. It's a database that law enforcement all over the country can access to find the criminals and prosecute identity theft cases. Finally, as part of our mission is education, and we are just very, very committed helping consumers understand what they can do to protect themselves and to feel empowered in this process, that they are not without tools and they can manage their credit information and do a better job in that. And finally, I just want to say that we're delighted to be here and want to work with the CFPB, particularly helping people, the most vulnerable population, service members, the elderly and so forth, recover from identity theft. I will just finally say that last month, USAA, one of our members, who of course represents a lot of military service member families, referred 317 people to us who we helped. So we're very proud of that fact. Thank you so much.
Thank you. Before we turn to Mr. Clemens, I should point out we've talked a lot about accuracy. I note, even from here, a grotesque typographical error in your name card there. So we do, in fact, live in an imperfect world. So, Mr. Clemens, please.
Thank you, Deputy Director Dante, Director Cordray, and the CFPB team for inviting us here today. Okay, thank you. The National Credit Reporting Association is celebrating our 20th year of representing our members who are known as resellers in the Fair Credit Reporting Act. These are specialty consumer reporting agencies that provide credit reports and other products to mortgage lenders and to tenant screening companies. NCRA members are 80% of the companies in the United States that can produce a credit report that meets the requirements of HUD, Fannie Mae, and Freddie Mac for mortgage lending. Our members routinely provide updates and corrections to these reports for mortgage lending and tenant screening. As we're discussing here today, for the first time, the government will start examining the credit reporting agencies in a way that is analogous with the banking industry has experienced for decades. While the credit reporting industry provides a vast majority of Americans a complete and accurate credit history, there are also many Americans who experience problems, and that's what we're focusing on. These problems have been well documented by the CFPB and the FTC through the volumes of complaints. NCRA's unique role of working with the consumers, the lenders, and the credit repositories to provide the most accurate credit reports possible gives us a unique perspective on this. We provide these lenders the most accurate credit reports possible by working with these channels. As we've also talked about, one of the greatest debates in the credit reporting system is about the accuracy of the data. It's important to remember that even at the most conservative 1% error rate, that means 2 million Americans have an error in their report that can create a problem when they're trying to seek shelter. To resolve these issues, I believe one of the most important elements that the CFPB can bring to this new supervision is that of not only reviewing the industry for compliance with the FCRA, but also examining the limitations put on the credit reporting process. Many of these limitations are imposed not by law, but by policies of dominant industry participants, lenders, and even the formerly government-sponsored enterprises Fannie Mae and Freddie Mac. Some of these limitations also come with questionable motives. For example, Fannie Mae and Freddie Mac completely rewrote the time and recession-tested mortgage credit reporting standards in the mid-1990s, seeking cheaper and faster reports to expedite mortgage lending. These expedited decisions were credit score driven and did not consider the alternative credit data only due to restraints of speed. The quest for speed and disregard for quality led to decisions based on incomplete and often inaccurate data, resulting in the recent credit crisis and enabling other bad lending decisions. This was a significant contributor to the housing crisis and unfortunately is a practice that's still in place today. In closing, we urge the CFPB to go deep into the weeds of the industry to truly understand the complex issues that drive it. Review some of the practices that developed during the era that brought about the mortgage crisis, critically questioning their real value and impact. Practices regarding credit reporting agencies being owned by the lender, whose greatest financial interest is the outcome of the loan. Practices like credit rescoring only offered to mortgage lenders. Compliance of programs with the ECOA that have policies that disregard credit trade lines only due to the size of the creditor. The impact of medical collections on a consumer's creditworthiness are just a few of the non-FCRA areas in need of your scrutiny to obtain a better harmony between the credit reporting agencies, the lenders, on behalf of the consumers we all ultimately serve. Thank you.
Thank you. Again, why don't we have the chance for some questions. Tom, would you mind starting?
Sure. This is for the industry panelists. Many consumers think of credit reports as a tool used to evaluate credit applications. But as we've heard today, there are a lot of other purposes that businesses use credit reports. So I would wonder if the panelists could provide for us a description of the range of types of business decisions that credit reports are used. And in that vein, if there's one big single change in the use of credit reports in the past generation or so, what would you say it is? Go start with Stuart.
So Tom, actually, it's a good thing I have Director Cordray's speech here because he answers that question in a lot of ways. Since 1970, the Fair Credit Reporting Act, the law that regulates the credit reporting industry, the law that regulates those that furnish data to the credit bureaus, and the law that regulates every company that uses the credit report, that law has had something called permissible purposes, a list of various uses that were permitted under the statute. And it's always been, of course, credit. And all the various aspects of credit, account portfolio review, making sure I understand that my portfolio is safe and sound longitudinally. But there's always been use of credit reports by a landlord who may want to evaluate a consumer's ability to pay or propensity to pay. It's always been true that insurers could use credit reports for underwriting. It's always been true that employment screening has been part of the consumer reporting agency regulation, and I think that's an important distinction that, of course, those who wrote the Fair Credit Reporting Act back in 1970 were very prescient. They didn't write a law that regulated just credit reports. They wrote a law that regulates consumer reports. It's a much wider span of data that is regulated for accuracy, where I have rights as a consumer to dispute that information. So Tom, in that sense, it's not new news. I would correct something that I've heard a couple of times, and that is that some would suggest there's an escalation in the use of credit reports for employment. We've surveyed our members, and we find 5% or less of the total transactions of the largest background screening companies in the country involve the use of a credit report. That is not inconsistent with the Society for Human Resources Management data. They surveyed their members and asked a simpler question: do you use a credit report ever for any job opening? And 60% of those employers said yes. For some job openings, I may use a credit report. In reality, once you get down to that granular level, though, of how often is a credit report really part of the screening process, the answer is very infrequently and used only for certain types of purposes. And that's why that's remarkably different. I think sometimes we're conflating kind of the larger number and the smaller number at the same time. But I think those are generally, Tom, the uses that have always been there, and they're regulated today just as they were back in 1970.
You know, I think one thing that we should also focus on that has changed, I think, is consumers' use of their credit reports. I will just say that our recovery service at ITEC is based on a credit report. So we couldn't do our recovery service if we didn't have the consumer's credit report and walk them through it to find what was accurate and what wasn't accurate. But again, I think that one thing that has changed is the extent to which consumers are aware of their credit report and use them and actively monitor what's in there to be sure that that it is accurate. So I do think that has changed, just consumer awareness of credit reports and the importance that it is to them in their lives and their active involvement in the process.
I'd like to add on to that in regards to something Stuart started in the use of credit for employment. First off, credit scores are not used in employment. A lot of people see in their disclosure that a credit report is going to be pulled, and they automatically think score because of the increase in consumer awareness. But scores are not utilized. And what we see from our members providing credit reports to the employment screening industry is also that what the credit report is used for many times is not for the data of how someone has paid their bills, but just confirming the identity of the applicant to make sure the Bob Smith that's applying for the loan is really the Bob Smith, and checking out other background investigation processes starting from that. So I think there's a little confusion there, and there's some misstatements in the press that have been fueling this debate.
Stuart, did you have something to follow up on?
Could I just make sure that we're pouring the right foundation in your hearing, and I realize we have more questions. I want to respond to just two thoughts that have been at the table. One is the question of accuracy. And candidly, accuracy of credit reports, nobody is more interested in the accuracy of credit reports than the industry itself. That's the product we sell. That's why we sell it. CDI represents resellers as well as the nationwide databases, probably the largest volume of all credit reports issued in this country overall. Deputy Director, I know you know this, but we're not shying away from the hard questions. When we were asked about accuracy, our largest corporate members gave us the money to establish a grant, and we went to a third party, and it was a let the chips fall where they may type of study. And we did study the question of accuracy, and I agree with the professor that accuracy is a difficult term to define. We looked at it a couple of different ways, though. We said when a score point changes over a period of time, we're measuring consequence of errors, not just simply whether or not my middle initial was missing from the credit report, because ultimately that's what's important to us. This gatekeeping document, did it or did it not let me in based on fair and correct information? So yes, it's true. We found that when you actually look at the real world of scorecards, in other words, how a lender prices and the price points that a lender charges, less than 0.5% of consumers have an item in their credit report which is going to cause them to move from a lower pricing tier to a higher pricing tier or vice versa. So in other words, and by the way, for the sake of transparency, not only was that produced, but we encouraged that third party, the PERC is the group out of Durham, North Carolina. We then turned not only the results of that data to the CFPB and to the FTC, but we also offered both the Federal Trade Commission and the CFPB the opportunity to obtain the raw data that was used to derive those results so that you weren't blind to what was underlying the results themselves, and you could retest that information, which we think is the better scientific method. And we sought outside professors at Duke University, the Wharton School of Business, University of Pennsylvania, as well as UNC Chapel Hill to peer review the work that we did to make sure that it met what we felt was more of an academic standard that you would consider in the scientific journal world. We're not shying away from those hard questions. That's part of this fact-based dialogue that we hope to have going forward. And by the way, Tom, I would applaud you for having reached out to PERC and having had a separate dialogue with PERC, independent of us, to hear a little bit about the accuracy study that we conducted. So.
Well, thank you. If I could just come back to this notion of credit reports being used, consumer reports being used in contexts other than lending decisions, especially in light and in the aftermath of the financial crisis. Bear with me for a second. If it's true that significant home price depreciation in some areas is tightly correlated with increased delinquencies on mortgages, and if it's true that, in some basic sense, the fact that my house just appreciated by 30% does not necessarily make me a worse driver. Can you talk about sort of what you have seen in terms of the use of reports after the crisis compared to before in some of these non-lending industries?
So I don't have data at my fingertips, of course, to fully flesh that out. But let's talk a little bit about the insurance industry's use of credit reports. And I understand how I drive my car and what does a credit report indicate about that. But I will tell you that, and this is really the benefit of what we call decision sciences, which is the broader umbrella in which we then develop credit scoring tools. And these tools are developed by third parties. You, of course, worked for a large lender at one time who had incredible internal decision sciences teams that could crunch data in a lot of different ways to manage risk and also to identify customers that you wanted to do business with. The data has proven out over time that these data do predict, these scoring technologies do predict loss ratios. That's a little bit different than the driving record, by the way. It's a loss ratio. How frequently do you make a claim against your policy? So that's really the question that's on the table for the insurer, and that's how insurers approach managing their portfolio. They ask the question, how often are you going to make a claim? Deputy Director, there's always more dialogue around that. You really would need a different panel up here to talk about the insurance industry uses. But I do think the science is there. And of course, the insurance commissioners across this country, not only do they have access to the baseline pricing tiers, but they also actually have access to the black box. In many states, the scoring technologies are turned over to the insurance commissioners, and there is a great deal of transparency that goes on between the insurance industry and those insurance commissioners.
Peggy, would you like to follow up on some items?
To talk again about accuracy, which is so fundamental, Stuart, I was just wondering if you could add, I understand you've heard some of the comments about particular problems with collections reporting and collections and the relationship between collections and accuracy. Can you shed any light on that? And any other area where I understand there was a study that the industry did that showed the levels you talked about at accuracy, but were there particular pockets of problems, or you can say more granularly what's going on there?
Okay, so let's talk about debt collection first. And Peggy, the nice thing about having you at the CFPB is you have this wealth of experience with the Fair Debt Collection Practices Act and of course the debt collection industry, having served in many, as a public servant in many different contexts, including at the Federal Trade Commission. So I think there will always be a higher rate of disputes around debt collection. There's always more tension around debt collection. So I think as a default, we can't look at the dispute rate and assume that by default all of those are valid disputes. There may be consumers, for example, in the credit card industry who haven't exercised their right under the Fair Credit Billing Act and unfortunately chose not to pay any of their bill as opposed to just simply not paying the item of information that was in dispute. With regard to medical collections, I think you'd have to have we don't see dispute rates that are so remarkably different that by default the entire industry is failing in some way. I will tell you this, the CDIA's members, through the Metro 2 format, we have a special training program for the debt collection industry. We're having an interesting outreach with some of the big software providers to make sure that at least to the extent that the debt collector is using one of these larger turnkey solutions, that we're encouraging them to use the latest version of Metro 2, which ensures precision in the reporting. And of course, we issue and reach out to, just like we do with other data furnisher communities, we have special FAQs to try to instruct them more specifically on how they should handle, for example, deleting the account when they're no longer responsible for collecting the account, or showing that the account is paid off when it in fact is paid off. We would agree with that. The credit reporting industry doesn't win by having an open collection item on the credit report if in fact it's been paid. I actually think debt collectors agree with that, by the way. They too want to show that the account is paid. They want to show that they've successfully collected it in the first place. Accuracy, do you want me to go to accuracy a little bit? Pockets of accuracy?
If there's 60 seconds of accuracy.
Okay, that's good. I like that, 60 seconds. First of all, there were no radical differences when we looked at the three national systems, so there were no differences between them in terms of patterns of accuracy overall. Otherwise, that would have been an element of the report going forward. We did not find, we had an excellent distribution. We slightly oversampled the African American population. We were right on point with the Hispanic population. So in that way, and we also had a study which had a superb distribution across the various scores as those scores distribute across the database as well. We did not find in any of those siloed reviews that there was some particular community that was singled out and had a problem that was a pattern or practice problem that was different than the population overall. So we had a lot of symmetry between the aggregate data and some of the more siloed data that we looked at as well.
Well, thank you. I should probably call an end to this phase of our field hearing, but I want to, I hope you will join me in thanking our panelists. This is an important part of our work, and you're making it possible really from day one, so thank you.
Thank you for your participation today. At this time, if you would rejoin the audience. Now Now it's time to hear from you as community leaders, advocates, industry representatives, residents, and consumers. The open mic portion of today's field hearing is an opportunity for the CFPB to hear about your experience with consumer credit reporting, to hear what is working well in the consumer credit reporting market and what is not. Each person will have 1 minute to tell us their story and experience with consumer credit reporting. We want to hear from as many of you as signed up to testify today, so please try to limit your statements. What we learn from you is incredibly valuable to the CFPB, so we would like to hear from as many of you as possible. Our first witness is Frank Diu. Laura is going to meet you right here.
I'm a father, and I'm also currently a victim of identity theft. It's been going on since 1997. This guy gets arrested, and he doesn't carry any ID on him. And then at that point, the cop goes back to his squad car, puts in the information, and goes on my state of Michigan iChat report. It's costing me jobs. I've lost jobs at Davenport University because of this. And he's not the only one. My father used my social and name too to buy cars and houses and things like that. And even on my TransUnion report, it said I was born in 1953. Not there. Thank you. And the other thing with the iChat report, it says I have tattoos all over my arms and neck and everywhere else. I mean, this is all false information. And it's pretty bad when I get a call at work and my son's school calls up and says, you can't go on the field trip or be a chaperone because of this background check we ran. And it's costing me a lot. I lost the house, and I'm just trying to recoup, and I've been dealing with this since. And accuracy is not even in the definition of what's going on here.
Thank you for that. It's not easy to share those types of stories with us, but we appreciate that you did so. Aaron Handelsman. Mary Ellen Lewis.
Hello, I'm Mary Ellen Lewis. I'm the acting chair of the Michigan Community Reinvestment Coalition, and I'm an elected board member of the National Community Reinvestment Coalition. I want to thank Director Cordray. We were very grateful to have you as our speaker here this spring at our national conference in Washington, D.C. It was very useful to all our membership. We're very grateful. And we're also very happy to have the Consumer Financial Protection Bureau visit us here in Michigan. We've all fought hard to make sure you got established, and we're still fighting hard to making sure you survive and get well-funded. So I was first told that I would have 3 minutes, and then when I signed in, 2 minutes, and now 1 minute. So I'll do my best, but please bear with me. I wanted to add a couple of things that probably won't be heard today. It's sort of academic, but I thought it might be useful for you to know that you probably already know, of course, at the agency, but there have been a number of alternative credit scoring models that have been tested out in the nonprofit sector since the early 2000s, even since the late 1990s. And a number of them have proven to be extremely effective. I think that I was very grateful to have the PERC, the Policy and Economic Research Council, mentioned earlier by a panelist, that they recently, that is June of this year, put out a report on their analysis of alternative credit reporting using data that is different than the usual credit scoring data. And they have found this called A New Pathway to Financial Inclusion. And if you just search on the web on that title, you could find it, A New Pathway to Financial Inclusion. The idea of it is that there are people that pay their rent on time every month, and there are people that pay their bills and may not have a credit card, or they may have fallen back behind on some of their credit cards or on their mortgage, but they always pay their rent or similar kinds of bills. So these alternative kinds of...
Thank you.
So, excuse me, does that mean I'm done?
Yes.
Okay, I'm going to quote it anyway. This is a quote from the report, which I think you'll find useful. Evidence is overwhelming and incontrovertible that alternative data is the single most powerful tool available to drive credit access, make consumer credit fairer and more inclusive, and help those with damaged credit rebuild their good credit standing.
Thank you. Mr. Charles Peltier. Robert Hershey. James Stevenson.
Yeah, I guess I would somewhat disagree with the panelists who kind of seem to minimize the effect of inaccuracies on people's credit report. Take a city like somewhere like Detroit, which has historically been subjected to redlining in lending and also in the insurance agencies. If you walked out this door right now and you did a survey of 100 people, you would probably find people with credit scores anywhere from 500 to 700. And if you asked them what was the interest rates on their loan, they would tell you 18 and 19% on auto loans throughout this entire city. So when you say that it's only a half-point interest if you were to correct this or correct that, that's not what's going on, because when consumers are going into these places, they're not told what the bar is. Is it 500? Is it 600? Is it 700? It's always a moving target as far as what category you fall in for the interest rate. So what role would the Consumer Financial Protection Bureau have in identifying what is the actual interest rate a person should be charged, as far as the abuses go? Because there doesn't seem to be a standard as to what a person should be charged. Just let the buyer beware. We're going to charge you whatever we feel we can get away with.
Thank you, Mr. Stevenson. Appreciate the comment. Melanie Duquines.
Melanie Ducanel. I am the president of the Better Business Bureau serving Eastern Michigan. So we get to see all kinds of things from identity theft, frauds, scams, and the like. But I'm also a 20-year, nickname myself a 20-year recovering banker. So when it comes to credit reporting, accuracy, it's imperative. There's no middle ground, quite honestly. But the other part of it that I'm hoping that CFPB can actually affect is looking at how we educate our consumers. And not just from our age group, it has to be at the elementary age group. And bringing back consumer education and that kind of thing is imperative to prevent this kind of stuff going on in the future.
Thank you. Carol Long.
Yes, I want to talk something about that accuracy, because it's bad for you to pull your credit report and find out you're dead. And I want to know who sent it in that I was dead, because evidently people see me, I'm not dead. And I don't know when they decided I was deceased. I pulled it in January and I was deceased. And I've been fighting them, I don't know how long.
We're confirming that we see and hear you today. Miss Kim Boyd Harris.
Hello. I would like to see more accountability in terms of mortgage servicing and accurate reporting, and also looking at the foreclosure prices. Our city has been devastated, and not to mention the credit history of those persons who should not have been foreclosed on. They're, trying to live with that. So there needs to be some accountability in terms of the information that was reported on the credit regarding foreclosure.
Thank you, Ms. Boyd Harris. Mr. Roy Zilgist. John Schoenberg.
Yeah. I'm on disability and was not able to pay credit cards. So for several years, I went through the courts. They all, gave judgments and collected my state taxes and everything, and it all disappeared. And I got judgments. Now all of a sudden I have these credit agencies attacking me because they've bought it from the other one, and the other one hasn't told them that I'm on disability. And one called me the other day and says, well, why don't you just put it on another credit card? I don't have any credit cards. I can't get a credit card. And the gentleman about auto insurance, since it's being put on my credit report, my auto insurance went up $200. I live in Harper Woods. But for the last 7, 8 years, and this is over a 10-year period that happened, and it all went away, and now it's back again. And for 7 years, my insurance rates were low. I had no claims, so what makes them think that it's any different? And they are using it to their advantage. All of a sudden, I asked my insurance guy, why'd it go up? He won't tell me. I says, how come it jumped $200 from the last time? Something's got to stop somewhere. I'm being predatorized. I can't afford, I'm under on my house. I got lucky with the bank because it was during the period that there was nothing on my report, and they did refinance my one loan. But if I could afford a lawyer to go to bankruptcy, I can't get help from anybody, so I can't get any relief. But the deal is this, is they keep selling it to the next credit. And I told them, I don't even owe you. In fact, the last one, the one that I owed for what they're trying to collect for, is Discovery, and they just sent me a thing to give me a credit card.
Thank you, Mr. Schoenberg. I appreciate that. Dave Sullivan.
Hi, thank you for coming. I've been providing credit reports to mortgage companies, banks, and credit unions for the last 20 years. And I'm sorry you're dead, ma'am, but you can come back from the dead. I actually am pleased that you are focusing on education. I started up a free website to provide education for free for people who die and want to come back. But I think you guys missed an important part of the industry that you're not overseeing, and that's the credit repair industry. The credit repair industry is wrought with scams and fraud. I really hope that you pick up that kind of oversight if you don't have it now. And hopefully we can put out the bad apples. There are good and bad in every industry. But for some reason, credit repair, there's a lot of bad apples out there. And by the way, the double whammy you were talking about earlier, it actually occurs more than that. It's like a triple or quadruple whammy because they keep selling it like that other guy was saying, and then they don't report it as paid. So fortunately, there is a system that people can get things corrected at the bureau level in one day, but you have to be applying for a mortgage like what Terry said. So anyway, that's all I have. Thank you.
Thank you, Mr. Sullivan. Tim Poxall.
First of all, I want to thank you for coming, but this statement really is much for the Congress members and their staffers as anything else. There's a lot of inaccuracy in the reporting of government documents, and when those government documents are reported to third party or private sources, those documents, when found to be wrong, people are actually being charged to make those corrections, any place from $99 in my research all the way up to $600 to make corrections that the government themselves admits either the person's status changed or whatever, or that they made a mistake in those documents in the first place. the Congress needs to pass a law that says that any government document that is used improperly or is shown to be used improperly, that that's against the law, or if they correct the document, that third-party users cannot charge somebody to make a correction there. Thank you.
Thank you, Mr. Paxall. Mac Elabed.
Brad Votter.
Yes, I'm Brad Vaughter. I'm an attorney in Lansing. I mainly work with senior citizens, but there's three observations that I hope that the Consumer Financial Protection Bureau will take into account as they go forward with the work. One is that there seems to be almost a perverse hit on the activist consumer who is regularly checking their accounts or is actually shopping for other rates. And the shopping for other rates can actually help lower a score rather than increase it. So your reward for being a consumer activist is perversely penalized. And we have some of the seniors I work with, the younger seniors who are still quite active with healthy incomes, finding that that has actually worked against them. Two other things I think, mainly based on my experience working with seniors. One is that I do think seniors are targeted more for ID fraud, and as Ann Wallace mentioned, their group is working with seniors. I do think that seniors, even though we have a pretty fast time frame, for instance, on credit card inaccuracies to report within 60 days, pay the undisputed portion, et cetera, and in general, I think that's good, but for some seniors, especially those on the edge of senility or Alzheimer's, where the relatives might be helping, those inaccuracies aren't often caught for 3 or 4 months. I think there should be a carve-out or an exception to let people repair those sort of reports or dispute those charges if there's some reasonable proof that I couldn't attend to this before this time because of such and such reason. When your granny's in the nursing home and you're going in to take care of things for her, it's not uncommon for that to be a 3 or 4 month lag through no fault of anybody, really. And the last thing I'd like to say very quickly is when collection agencies, collection groups, not necessarily the reporting groups, but when collection agencies, if you turn to them in your work, I think that they should be required when they forward the file and the senior or somebody, the consumer, has already put in a do not contact letter or already explained in great detail, my only income is Social Security disability. Your threats to garnish my income are, unfair and improper. I think that the forwarder must send that information on to the next person so that the poor slob consumer doesn't have to write these letters every 3 months or so when the file changes hands.
Thank you, Mr. Potter. David Leclerc.
Hello, I'm David Leclerc. I'm with Michigan Lending Solutions. We're owned by 5 nonprofit organizations through the state of Michigan. First, I'd say a story about a client that we are working with. For the last 21 days, we've been trying to get his credit report corrected. On this credit report, he has a tax lien and 2 other collections that are his father's, not his. We reported to the bureaus. The bureaus came back and said that they were wrong, but they won't correct the credit report because now they're asking $423 in fees to be removed. So he will not get approved for a mortgage because of this. The other item I want to bring up is the gentleman brought up about counseling. All of our agencies provide credit counseling, pre-purchase counseling. The industry is fraught with fraud and scams, especially on the credit side. In my 24 years in banking, I've never seen credit as bad as it is today. And these people are being taken advantage of by for-profit entities. It really needs to be regulated, and the counselors really need to be provided better education on how to correct these things and to provide that information to the consumer. It'd be great to see this Bureau do that.
Thank you, Mr. Leclerc. Mr. Ian Linklip.
Thank you. My name is Ian Linklip. I'm a consumer protection attorney. I have been litigating consumer cases for the last 17, 18 years, the last dozen years representing victims of identity theft, mismerges, and other credit reporting errors. The statute's missing something. It's missing transparency, enforceability, and accountability for inaccuracies in these credit reports. It is not funny. I mean, with all deference, I understand the difficulty this poor woman's having, but it's not funny. The fact of the matter is, we're all standing in a room here. We're all standing in a room here looking at a woman who has been reported as dead. We can see she's not dead. The bureaus can see she's not dead. And if she were to walk into my office today and want help, I'd have to ask her whether or not she's been denied credit because she's dead. And she would have to tell me, she said, I don't know. And I couldn't do anything for her. I can't make the bureaus stop. I can't make the furnishers who are reporting that information stop. I can't get a declaration that those reports are inaccurate. We are standing here in a room looking at a dead person, and there is literally nothing that this statute will allow us to do to help this woman. There is no federal right to an accurate credit report. That is the absolute truth. Everybody who has an error in their credit report and has banged their head against the walls for years, your remedy is take out a pen and keep it up. This statute needs to change. That is the enforcement mechanism that has been provided in any number of other consumer protection statutes to obtain declarations, to obtain injunctions against further wrong conduct. But this statute, with its negligence standards, its requirements that we prove actual damage, leave people like this absolutely without any remedy. And by the time that she gets to something that is actual damage, we will not be able to help her. And that lawsuit, if we have to bring it, is going to be enormously expensive. If we have to go take depositions, we're going to be taking depositions in literally India and Jamaica, where the credit reporting agencies have sent all of our credit reporting data for reinvestigations. The fact of the matter is that only the best heeled, the best financed consumer attorneys in the country can afford to take only the best cases. Your own records show that there are millions of people who've been banging their heads against the wall for years, and the one remedy, we're talking about all sorts of notices, literally dozens of notices, and I've written the chapter in the NCLC manual on notices, literally dozens of notices.
Thank you, Mr. Linklip.
Thank you very much for the time. I appreciate it.
Cheryl Carpenter.
Hello. I am a criminal defense attorney, and you might wonder, why am I here? I am here because we have a huge problem with credit reporting for people who were on the sex offender registry. I'm on a coalition for a youthful registry. I have had youthful offenders, these are teenagers who had consensual sex, no conviction on their record. I have got them removed from the sex offender registry, but we have private industries who are preying on these people. There is somebody called Offendex, says if you pay us $499, we will take this off our public website. I don't care about a court order that you're not on the registry. I don't care you don't have a conviction. But unless you pay us, we are going to ruin your lives. And this is affecting, there's HomeFacts, which goes to if you're trying to rent an apartment, they use old data. They ruin people's lives, and they're doing this for profit. And we need to have a law. We need to have some protection for these people who are no longer on the registry so their lives aren't ruined. They can't get a job, they can't get an apartment, they can't live. Thank you.
Thank you for that testimony. That concludes the field hearing in Detroit, Michigan. Thank you all for attending, and thank you all who watched on live stream.